Smart investing isn't just about making money, it's about securing a future, building a legacy, and creating opportunities. Picture this. You're not just stacking up cash in a vault. No, you're planting seeds in fertile soil, nurturing them, and watching as they grow into a forest of financial security and abundance. Investing wisely is your ticket to financial freedom. It's the key that unlocks doors to new possibilities, from owning your dream home to funding your child's education, or even retiring early. And here's the thing, investing isn't just for the fat cats on Wall Street, it's for everyone. Yes, you heard it right, everyone. Whether you're a fresh graduate, a seasoned professional, or a retiree, there's an investment strategy out there for you. So let's not wait any longer. Let's grab the bull by the horns and start paving your path to financial freedom. Now let's dive into the top 5 investment strategies that can help you achieve your financial goals. Scene script. Number 1 on our list is diversification. Now, if you've ever heard the phrase, "Don't put all your eggs in one basket," then you're already familiar with the concept of diversification. In the world of investing, diversification is about spreading your investments across different types of assets to reduce risk. It's a strategy that's all about balance and playing the long game. Think of it this way. You wouldn't want to build a meal around just one ingredient, right? Similarly, building an investment portfolio around just one asset can be risky. If that one asset performs poorly, your entire portfolio suffers. But if you have a diverse mix of assets, the poor performance of one can potentially be offset by the strong performance of another. So, what does a diversified portfolio look like? Well, it could include a mix of stocks, bonds, real estate, and perhaps even some commodities or mutual funds. Each of these asset classes has its own risk and return characteristics. For instance, stocks can potentially offer high returns but come with higher risk, while bonds are generally lower risk but offer more modest returns. By having a mix of these assets, you're spreading the risk. It's like having a safety net. If stocks take a nosedive, your bonds or real estate investments might still be performing well and cushion the blow. And on the other hand, if bonds are sluggish, your stocks could be soaring. But remember, diversification isn't just about having different types of assets. It's also about having assets that don't all move in the same direction at the same time. This is known as correlation. In an ideal world, you want assets that have a low correlation with each other. That way, when one zigs, the other zags. So, take a step back and look at your portfolio. Is it all stocks, all bonds, all tech? If so, you might want to consider diversifying. It's not a guarantee against loss, but it's a proven strategy to manage risk and potentially enhance returns over time. In essence, don't put all your eggs in one basket. Second on our list is dollar cost averaging. This strategy is all about consistency. It's a method where you invest a fixed amount of money at regular intervals, regardless of the market's ups and downs. You might be wondering, why would I invest when the market's down? Well, that's where the magic of dollar cost averaging comes into play. When the market dips, your fixed investment buys more shares, and when the market climbs, it buys fewer. Over time, this can lower the average cost per share of your investments. This strategy mitigates the risk of investing a large amount in a single transaction at the wrong time. It's like taking a long-term, steady approach to investing rather than trying to time the market and potentially missing the boat. So, if you're looking for a strategy with lower risk and a potential for steady growth, consider dollar cost averaging. With dollar cost averaging, consistency is key. Third on our list is value investing. Now let's dive into the realm of stocks that are diamonds in the rough. Value investing is a strategy that zeroes in on companies that are undervalued in the marketplace. The secret sauce here is fundamental analysis, a method used to gauge a company's intrinsic value. The charm of value investing lies in its simplicity. The strategy is like shopping for bargains, except the bargains are shares of a company. The goal is to find those stocks that are underpriced relative to the company's true worth. It's about having an eye for value where others only see risk. But how does one determine if a stock is undervalued? This is where the fundamental analysis comes into play. It involves digging deep into a company's financials, looking at aspects like earnings, revenue, cash flow, and debt. But it doesn't stop there. A savvy value investor also looks at the company's market position, its competitive advantages, and the industry it operates in. For instance, let's say a company has a low price-to-earnings ratio compared to its competitors. This could indicate that the company is undervalued, presenting a potentially profitable opportunity for the value investor. Or a company could be facing short-term challenges that have led to a drop in its stock price, while its long-term prospects remain strong. A value investor might see this as a chance to buy the stock at a discount. However, it's important to note that value investing requires patience and discipline. It's not about making quick bucks. The real payoff comes over time as the market gradually recognizes the company's true worth and the stock price adjusts upward. Value investing has been the strategy of choice for many legendary investors, including Warren Buffett. It's a testament to the power of understanding a company's fundamentals and having the patience to wait for the market to catch up. Value investing is all about recognizing worth where others may not. It's about seeing potential where others see uncertainty and having the conviction to back your analysis with your investment. Fourth on our list is growth investing. Now, this strategy is an interesting one. It involves investing in companies that are expected to grow at an above-average rate compared to other companies in the market. The idea here is to identify businesses that have the potential for significant growth regardless of their current size. These could be small startups with innovative ideas or products, or larger, well-established companies that are expanding into new markets or developing new technologies. The key is that these companies are expected to grow at an above-average pace, and as a result, so should the return on your investment. However, it's important to remember that with the potential for higher returns comes the potential for higher risk. Growth investing can be a bit like a roller coaster ride. When things are going well, the sky's the limit. But when they're not, you might find yourself wishing you'd stayed on solid ground. That's why it's essential to do your research and understand the company you're investing in. What's driving its growth? Is it sustainable? And perhaps most importantly, are you comfortable with the level of risk involved? In the end, growth investing is not for the faint of heart. It requires a willingness to take on potentially higher risk for the chance of higher reward. It's about being bold, taking chances, and yes, sometimes even embracing uncertainty. After all, growth investing is about betting on the future. Last but not least, index investing. This strategy is the epitome of going with the flow. Instead of trying to outwit the market, you ride along with it. Index investing involves putting your money in a broad market index or a segment of the market. An index, for those scratching their heads, represents a section of the stock market. It could be the entire market, like the S&P 500, or a specific sector like technology or healthcare. This approach is a passive investment strategy. It's like setting your sail and letting the wind, or in this case, the market, guide you. The goal here is not to beat the market, but to generate returns that closely track a specific index. This strategy is favored for its simplicity and lower costs. It's like having a slice of the entire market pie, and as the pie grows, so does your slice. Index investing lets the market do the work for you. So there you have it, the top 5 investment strategies. Let's quickly jog your memory. We explored diversification, the art of spreading the risk, then dollar-cost averaging, a disciplined approach to investing. Next, we delved into value investing, the hunt for undervalued assets, and growth investing, targeting companies with promising future potential. Lastly, we discussed index investing, a passive approach mirroring market performance. Remember, the key to successful investing is not just about choosing the right strategies, but also about patience, consistency, and a deep understanding of your financial goals.
Pause. Reflect. 5 unbeatable investment strategies just danced across your screen. The world of finance might seem like a complex labyrinth, but with these strategies, you're holding the map. Remember, diversification is your safety net, dollar cost averaging your constant companion. Value investing? It's the Sherlock Holmes of the finance world, always seeking undervalued assets. Growth investing, on the other hand, is the visionary, always looking towards future potential. And finally, the index fund strategy. The tortoise in the race, slow and steady, yet often outpacing the hare. Each one, a tool in your investment toolkit. Master them, and you're not just playing the game, you're changing its rules. Until next time, keep your strategy sharp and your investments sharper. Over and out.